I need to tell you something that changed how I think about the next decade. 3 months ago, I made a decision that most financial advisors would have called reckless. I allocated a significant portion of my portfolio to physical gold and silver at prices that were, at the time, near all-time highs. Not trading positions, not speculative plays. Real metal. Stored. Owned. The comments flooded in. You're buying at the top. Wait for the pullback. Gold is in a bubble. I heard it all. I expected it all. And I did it anyway. What happened next didn't surprise me because of the price movement. It surprised me because of what the price movement revealed about the state of our financial system, about the acceleration of forces that most investors are still not paying attention to. This isn't a story about getting rich quick. This is about watching, in real time, the rules of the game change beneath our feet. If you own gold or silver right now, you need to understand what's happening beyond the daily price charts. If you don't own any, you need to understand why the investors who do are not selling despite volatility, despite criticism, despite every talking head on financial television calling them outdated relics of a bygone era. Something fundamental has shifted in the global monetary system, not overnight, not because of one event, but through a slow accumulation of policy decisions, debt expansion, and currency debasement that has reached a tipping point. The outcome I'm referring to isn't about whether gold went up or down in the short term. It's about what I learned watching the macro forces that now control the trajectory of our monetary future, forces that most people fundamentally misunderstand. This video is for people who want to understand what's actually happening. Not what the headlines say, not what drives clicks, what the data shows when you strip away the noise. Let's start with where we are. Global debt has now exceeded $330 trillion. That number is almost impossible to comprehend. It represents roughly 330% of global GDP. We're not talking about government debt alone. This includes corporate debt, household debt, and the shadow banking system that few people even know exists. Governments around the world have accumulated obligations they mathematically cannot repay through conventional means. Not won't repay. Cannot repay. The arithmetic doesn't work. When your debt grows faster than your economy and your interest payments begin consuming larger portions of your tax revenue, you face a choice. You can default, you can restructure, or you can inflate your way out. History shows us that governments always choose the third option. Always. Because it's the politically palatable one. It's the invisible tax. The one that doesn't require a vote or announcement. It happens through monetary policy, through the printing press, through the gradual erosion of purchasing power. This isn't theory. This is pattern recognition based on thousands of years of monetary history. Inflation is not, as many people believe, simply prices going up. That's the symptom. Inflation is the expansion of the money supply relative to the goods and services available in an economy. Over the past 4 years, central banks have created more currency units than existed in the prior century combined. Let that sink in. More dollars, euros, yen, and pounds were created between 2020 and 2024 than in the 100 years before. What does that do to the value of each existing unit? Simple mathematics tells us it dilutes it. Each dollar in your bank account represents a smaller claim on the total pool of goods and services. The people who understand this bought hard assets, real estate, commodities, productive businesses. And yes, gold and silver, not because they're speculators, because they understand that holding currency during periods of monetary expansion is a guaranteed way to lose purchasing power. The crisis isn't coming. The crisis is here. It's just moving slowly enough that most people don't recognize it as a crisis. They see it as the new normal. Higher prices, lower living standards. The gradual erosion of savings. Central banks found themselves in an impossible position. For over a decade, they suppressed interest rates to stimulate growth and manage debt burdens. Rates near zero became normal. In some countries, rates went negative. You paid the bank to hold your money. Then inflation appeared. Real inflation, not the 2% target kind. The kind that shows up in grocery bills and energy costs and housing. The kind that people actually feel. Central banks had to raise rates. But here's the problem. The system had become addicted to cheap money. Governments, corporations, and households had taken on debt, assuming rates would stay low forever. When rates rose, everything started breaking. Banks collapsed. Bond portfolios imploded. Real estate markets wobbled. The everything bubble, inflated by a decade of free money, began showing cracks. So central banks found themselves trapped between two choices: keep rates high and watch the debt structure collapse, or cut rates and let inflation run. They chose a third path. Pretend you're fighting inflation while quietly ensuring the system doesn't implode. Raise rates just enough to signal credibility, but not enough to actually stop the underlying monetary expansion. This is where we are now, trapped in a policy purgatory where every decision creates new problems. The average investor has been trained to think in cycles. Bull markets and bear markets, recessions and recoveries, everything mean reverts. Everything goes back to normal eventually. That framework worked for decades because the underlying monetary system was relatively stable. Yes, we had inflation. Yes, we had recessions. But the dollar maintained its basic purchasing power over multi-decade periods. The system corrected itself through normal market mechanisms. That framework is breaking down. We're not in a normal cycle anymore. We're in the late stages of a debt supercycle that began in the 1970s. Each crisis over the past 50 years was solved the same way. Add more debt, lower rates, expand the money supply, kick the can down the road, but roads eventually end. What happens when you can't lower rates anymore because they're already at zero? What happens when you can't add more debt without triggering a sovereign debt crisis? What happens when the currency itself becomes the problem? Most investors are still using old maps to navigate new territory. They're waiting for things to go back to normal, but normal is not coming back. We're entering a new paradigm, one that requires a different approach to preserving wealth. This isn't the first time a major monetary system has faced this kind of pressure. Look at the 1970s. Inflation accelerated, currency lost purchasing power, stocks went sideways for a decade, bonds got crushed, traditional investment strategies failed. What worked? Hard assets, commodities. Gold went from $35 to over $800. Silver multiplied even more dramatically, not because of speculation, because people were fleeing currency debasement. Look at the Weimar Republic, the Roman Empire, the continental dollar, the British pound sterling before it lost reserve status. Every time a government tries to print its way out of insolvency, the same pattern emerges. Those who hold the currency suffer. Those who hold real assets preserve wealth. Sometimes they even prosper. But the prosperity isn't the goal. Preservation is the goal. The investors who succeeded in those environments weren't the ones who perfectly timed the bottom or top. They were the ones who recognized the macro shift early, positioned accordingly, and held through volatility. Here's what makes this difficult. Your brain will fight you. When I bought gold and silver at record prices, every instinct screamed at me to wait. Wait for a pullback, wait for confirmation, wait for the mainstream to validate the decision. But that's not how major financial transitions work. By the time everyone agrees, by the time it's safe, by the time the data is undeniable, the opportunity has passed. The best investments always feel uncomfortable. They go against consensus. They require you to stand apart from the crowd and accept short-term criticism for long-term positioning. This is especially true with gold and silver. These assets carry emotional baggage. They're associated with doomsday preppers and conspiracy theorists in the popular imagination. Mainstream finance dismisses them as barbarous relics. But central banks don't think they're barbarous relics. Central banks have been accumulating gold at the fastest pace in decades. China, Russia, India, Turkey, Poland, countries around the world are buying physical gold and repatriating their reserves. Why? Because they understand what's coming. They understand that in a world of competitive currency debasement, gold is the ultimate neutral asset. It has no counterparty risk. It can't be printed. It can't be defaulted on. If you already hold these assets, you need to understand your position differently than you might have 6 months ago. You're not waiting for a trade to work out. You're holding insurance during a period of systemic instability. Your position is a hedge against currency debasement, banking system stress, and the continued expansion of unpayable debt. Short-term volatility is irrelevant. Gold and silver will have pullbacks. They will have periods where they underperform stocks or real estate. There will be moments when you question whether you made the right decision. Those moments are the test. The investors who succeed in this environment are the ones who understand the macro thesis and don't let short-term price action shake them out. Your focus should be on position sizing. Do you own enough to make a difference if the currency loses significant purchasing power? Do you own so much that you can't sleep at night during volatility? The right allocation is personal. It depends on your age, risk tolerance, and overall financial situation. But the principle is universal. Gold and silver should be held as strategic reserves, not trading positions. You don't sell insurance the moment you think the storm might pass. You hold it until the underlying conditions change, until debt levels normalize, until central banks stop expanding money supply, until the system rebalances. We're nowhere near that point yet. If you don't currently hold gold or silver, you're facing a different question. Is it too late? Let me be direct. Nobody can tell you with certainty what will happen to prices tomorrow, next month, or next year. Anyone who claims they can is either lying or delusional. What I can tell you is this. The fundamental drivers that pushed gold and silver to current levels have not resolved. They've intensified. Debt continues to expand. Money supply continues to grow. Central banks continue to add gold to reserves. Currency devaluation continues across major economies. The structural problems in the financial system remain unaddressed. Does that guarantee prices go higher? No. Markets can be irrational longer than you can stay solvent. Short-term price action is driven by technical factors, positioning, sentiment. things that have nothing to do with fundamentals. But if you believe the macro thesis, if you understand the historical pattern, if you recognize that we're in the late stages of a debt supercycle, then starting a position makes sense regardless of current prices. The key word is starting. Not plunging, not betting the farm, starting. Dollar cost averaging into a position over time removes the pressure of trying to time the bottom. It lets you build exposure gradually while continuing to learn and adjust your thesis. Think about it this way. If someone in 2019 decided gold was too expensive at $1,400 and waited for a better entry, they're still waiting. Meanwhile, gold has crossed significant milestones and central banks have continued accumulating. Waiting for the perfect price is another form of market timing. And market timing, especially in macro-driven moves, is nearly impossible. Silver deserves specific attention because it behaves differently than gold. Gold is primarily monetary. It's held by central banks, institutional investors, and individuals as a store of value. Its price is driven by monetary conditions, currency strength, and inflation expectations. Silver is both monetary and industrial. More than half of silver demand comes from industrial applications: solar panels, electronics, electric vehicles, medical devices. This dual nature creates unique dynamics. When the economy expands, industrial demand for silver rises. When monetary conditions deteriorate, investment demand for silver rises. When both happen simultaneously, silver can outperform gold dramatically. The historical gold to silver ratio, the number of silver ounces needed to buy 1 ounce of gold, has averaged around 60 to 1 over the past century. It's currently trading well above that historical average. Does that mean silver is guaranteed to outperform? No. Guarantees don't exist in markets. But it does suggest that silver may offer more upside potential if the monetary thesis plays out, while also carrying more volatility and downside risk. Some investors hold both for this reason. Gold is the stable core holding. Silver is the more speculative, higher beta play on the same macro thesis. This is critical, so listen carefully. Do not panic buy. Do not liquidate your entire portfolio and go all in on metals. Do not borrow money to buy gold and silver. Do not buy based on fear or FOMO. Do not chase price spikes. Every bull market in precious metals attracts speculators who get wiped out. They buy high on emotion. They leverage up. They convince themselves that prices only go in one direction. Then volatility hits, they get margin called, and they sell at the worst possible time. The investors who succeed do the opposite. They position gradually. They size appropriately. They hold through volatility. They understand that preservation of capital matters more than hitting home runs. Do not follow social media hype. Twitter, YouTube, Reddit. They're filled with people making bold predictions and showing screenshots of massive gains. What they don't show you are the losses, the blown-up accounts, the people who bought at the top of the last cycle and held through years of underperformance. Do not stop educating yourself. The decision to own gold and silver should be based on understanding, not blind faith. Read about monetary history, study previous debt crises, understand how central banks operate, learn about mining supply dynamics and industrial demand factors. Knowledge is your greatest asset. It keeps you calm during volatility. It helps you separate signal from noise. It prevents you from making emotional decisions that destroy wealth. Do not ignore other aspects of financial health. Gold and silver should be part of a diversified strategy, not your entire strategy. You still need emergency savings. You still need productive assets. You still need income streams. Diversification isn't about maximizing returns. It's about surviving different scenarios. Maybe inflation accelerates and gold performs brilliantly. Maybe we get deflation and cash is king. Maybe productive businesses continue generating returns despite macro headwinds. Nobody knows which scenario will play out. Position for multiple possibilities. The investors I respect most share common traits. They think in probabilities, not certainties. They ask what might happen rather than what will happen. They build portfolios that can survive multiple scenarios rather than betting everything on one outcome. They focus on risk before return. The first question isn't how much can I make, it's how much can I lose? Position sizing flows from this mindset. You risk what you can afford to lose while ensuring that being right creates meaningful benefit. They separate signal from noise. Daily price movements are noise. Monthly trends are usually noise. Even annual returns can be noise in the context of multi-decade cycles. What matters is the underlying fundamentals. Are the forces that drove your initial decision still in place? If yes, hold. If no, reassess. They manage emotions. Fear and greed destroy more wealth than bad analysis. When everyone is panicking, disciplined investors stay calm. When everyone is euphoric, disciplined investors get cautious. Emotional control is a competitive advantage. They maintain perspective. One investment, one asset class, one trade doesn't determine your financial future. Your overall approach to building and preserving wealth matters more than any single position. This perspective helps during inevitable periods of underperformance. Gold and silver will have times when they lag stocks, real estate, or other assets. Those periods test your conviction. If you understand why you own them, if your thesis remains intact, temporary underperformance is irrelevant. Zoom out for a moment. Over the past century, gold has preserved purchasing power through the Great Depression, World War II, the stagflation of the 1970s, the dot-com bubble, the financial crisis, and the monetary experiment of the past 15 years. Did it make spectacular returns every year? No. Were there long periods of stagnation? Yes. But through every major crisis, through every currency devaluation, through every sovereign default, gold maintained its fundamental value. That's what makes it different from financial assets. Stocks can go to zero, bonds can default, real estate can decline dramatically, companies can go bankrupt, governments can collapse. Gold just is. It doesn't have earnings. It doesn't have cash flow. It doesn't have counterparty risk. It's simply a physical store of value that has been recognized as such for thousands of years. Is that old-fashioned? Maybe. Is it less exciting than cryptocurrency or tech stocks or private equity? Absolutely. Does it matter when the financial system is under stress? Ask anyone who lived through the Weimar Republic, the collapse of the Soviet Union, or the Argentine debt crisis. Gold and silver don't exist in isolation. They're part of a broader discussion about how to position wealth during this unique period. Real assets are generally performing well. Commodities, energy, agricultural land, infrastructure, things that have tangible value and generate real economic utility. Financial assets are more complicated. Stocks have benefited from monetary expansion, but valuations are stretched by historical standards. Bonds have suffered from rising rates and inflation concerns. Cash is losing purchasing power to inflation. The traditional 60-40 portfolio, 60% stocks, 40% bonds, has had its worst performance in generations. The assumptions that portfolio was built on no longer hold. Bonds aren't providing the defensive characteristics they once did. Diversification within financial assets alone isn't providing protection. This is why alternative allocations are gaining attention. Not just gold and silver, but other real assets, absolute return strategies, inflation-protected securities, and non-correlated return streams. The portfolio that worked for the past 40 years, buy stocks and bonds, hold long-term, rebalance annually, needs reassessment in an environment of currency debasement and financial repression. Gold doesn't pay dividends or interest. True. But the dollar in your bank account is losing purchasing power. Treasury bonds are yielding less than inflation. What's the real return after accounting for currency debasement? Gold's return is preservation. In an environment where preservation is difficult, that's valuable. You can't eat gold. Also true. But you can't eat dollars either. Both are mediums of exchange and stores of value. The question is which one maintains purchasing power better over time in the current environment. Governments could confiscate gold. They could. It's happened before. But if we reach a point where governments are confiscating private gold holdings, we have bigger problems than portfolio allocation. That scenario implies complete breakdown of property rights and rule of law. The more likely scenario is currency controls, capital controls, and wealth taxes on financial assets, all of which are easier to implement and harder to resist than physical confiscation. Bitcoin is better than gold. This isn't an either-or question. Bitcoin and gold serve different purposes and have different risk profiles. Bitcoin is new, digital, scarce, and revolutionary. Gold is ancient, physical, proven, and boring. Some investors hold both. Some prefer one over the other. The important point is that both represent attempts to opt out of the fiat currency system and preserve wealth outside traditional financial assets. Let me bring this back to why I made the decision I did. I looked at my portfolio and realized that despite years of saving and investing, I was entirely dependent on the continued stability of the financial system. My net worth was numbers in bank accounts and brokerage statements, digital entries that could be frozen, taxed, or devalued. That realization was uncomfortable. I had built wealth according to conventional wisdom: maximize returns, minimize taxes, diversify across stocks and bonds. But I had zero hedge against the system itself becoming the problem. Buying physical gold and silver at record prices wasn't a bet that prices would go higher. It was recognition that I needed an anchor outside the financial system, something that would maintain value regardless of what happened to banks, currencies, or markets. The outcome that left me speechless wasn't the price movement. It was the peace of mind that came from knowing part of my wealth was truly mine, not dependent on institutions, not at risk of counterparty failure, not subject to being inflated away. That psychological shift matters more than any short-term gain or loss in the metal prices themselves. Where do we go from here? The honest answer is nobody knows with certainty. The path ahead is probabilistic, not predetermined. But we can identify the likely scenarios and position accordingly. Scenario 1, central banks regain control of inflation without triggering recession. Rates normalize, debt levels stabilize, the system muddles through, In this scenario, gold and silver probably underperform stocks and other risk assets, but maintain purchasing power. Scenario 2. Inflation remains elevated despite rate hikes. Currency purchasing power continues eroding. Real yields stay negative. In this scenario, gold and silver likely perform well as stores of value and inflation hedges. Scenario 3. Something breaks. Banking stress, sovereign debt crisis, currency crisis, major policy mistake. In this scenario, gold and silver potentially see explosive moves as safe haven flows accelerate. Scenario 4. Deflation. Debt deflation forces deleveraging. Asset prices collapse. Cash becomes king. This is the nightmare scenario for gold bulls, but also the scenario where physical possession of any real asset becomes valuable. Which scenario will play out? Probably some combination of all of them at different times in different markets. The point isn't to predict the path. It's to position in a way that allows you to survive and potentially benefit from multiple possibilities. The greatest lesson from this experience isn't about gold or silver specifically. It's about the importance of independent thinking and investing. Most people outsource their financial decisions. They follow conventional wisdom. They do what everyone else is doing. They trust that the system will continue functioning the way it always has. That approach works fine during periods of stability. But during transitions, during periods where the fundamental rules are changing, conventional wisdom becomes dangerous. The investors who built and preserved wealth through the great transitions of the past century were the ones who questioned consensus, who looked at fundamental forces rather than price charts, who positioned before the crowd, not after. You don't need to be contrarian for the sake of being contrarian, but you do need to develop independent judgment based on understanding rather than following. Read history, study economics, understand how monetary systems work and how they fail, learn to separate signal from noise, build conviction based on knowledge rather than emotion. Those skills will serve you regardless of what happens to gold, silver, or any other specific asset. I titled this video with a personal story because that's what this is. My experience paying record prices for gold and silver taught me something more valuable than any short-term profit. It taught me that the greatest risk in investing isn't volatility or temporary losses. It's failing to position for the macro forces that determine long-term outcomes. It taught me that consensus is often wrong at inflection points, that what feels uncomfortable is often exactly what you should be doing, that preservation of wealth requires thinking beyond the next quarter or year. Most importantly, it taught me that education and understanding are the real assets. Gold and silver are just tools. The real value is knowing why you hold them, when to hold them, and how they fit into a broader strategy for navigating an uncertain world. If you take nothing else from this video, take this. Stay curious, stay informed, stay disciplined. Don't react to headlines, don't follow hype. Build understanding and let that guide your decisions. The crisis isn't coming. It's here. It's just unfolding slowly enough that most people don't recognize it yet. By the time it's obvious, by the time everyone agrees, the opportunity to position will have passed. Whether you choose to own gold and silver or not is less important than whether you understand the forces reshaping our monetary system. Whether you recognize that we're in the late stages of a debt supercycle. Whether you position your wealth to survive the transition. I can't tell you what to do. Nobody can. Only you understand your situation, your risk tolerance, your goals, your timeline. What I can tell you is this. The investors who succeed in the years ahead won't be the ones who perfectly time markets. They'll be the ones who understood the macro shift, positioned accordingly, and had the discipline to hold through volatility. They'll be the ones who chose understanding over following, education over emotion, long-term thinking over short-term trading. Be one of those investors. Not because it's exciting, because it works. The outcome that left me speechless wasn't about getting rich. It was about understanding, finally, what's at stake and what to do about it. Thank you for watching. Stay informed, stay thoughtful, and stay positioned for whatever comes next.